Now, this is a special. It's a flash update for you all because I know that you're all interested in that special yellow fruit, the banana, for the banana zone. The banana zone is that point when crypto prices go exponential. And while we all love this and our hopes and dreams are all in that yellow fruit, I wanted to get everybody on the same page of understanding so you know where we are and why we're here. So I'm going to run through a selection of charts, many of which you'll never seen before, that gives you a much deeper understanding of what's going on and what we might be able to look forward to ahead. Because the banana zone is a very special time.
Raoul Pal, a leading macro analyst and prominent figure in the cryptocurrency world, continues to deliver sharp insights into the future of digital assets. As a former Goldman Sachs executive and a well-known crypto bull, Pal's work centers around how macroeconomic shifts affect the global financial landscape, particularly in the cryptocurrency and digital asset markets where he has significant investments. According to Pal, the macro environment is on the verge of a major transformation as central banks shift from quantitative tightening and aggressive rate hikes to more accommodative policies like rate cuts and quantitative easing. This change, he explains, is crucial to preventing global economies from overheating. The U.S. Federal Reserve recently signaled the start of this transition, announcing its first rate cut since the pandemic began. Pal believes these improving liquidity conditions will lead to explosive growth in the cryptocurrency market. While he is optimistic about the entire space, he highlights Bitcoin, Ethereum, Solana, and Sui as standout assets poised for significant gains, with Solana at the forefront of the next market cycle. In his latest Real Vision update, Pal discusses the evolving macroeconomic environment and provides his outlook for the cryptocurrency market over the next few months. He also shares his investment strategy for capitalizing on what he sees as a $100 trillion opportunity in the crypto space, identifying key areas for growth and positioning for long-term success. Join us as we break down Pal's insights, including his thoughts on the banana zone and the cryptocurrencies he's backing for 2025 and beyond. Be sure to like, share, and subscribe for more in-depth discussions. And check out our other videos featuring industry leaders like Michael Saylor, Cathie Wood, and Lynn Alden.
Firstly, I've said this before to you all, it's all about demographics. Remember that magic formula that I've talked about in the past where GDP growth equals population growth plus productivity growth plus debt growth. Okay, got that? Well, this is the important bit. The labour force participation rate in black here has been falling for a couple of decades. That is because the population is beginning to age, and so less people are in the workforce. Now, you can see in pink, it's the births-deaths rate that is actually driving this. So as population growth has been slowing, the workforce slows over time as people get older. Okay, so that's pretty clear. An old population, however, because of the magic formula, less people in the workforce means less GDP. So trend rate of GDP has been slowing. So the economy's been slowing over time. This chart is a chart you'll never see anywhere else, and I think it's the single most important chart in all of global macro. So what is it? It's that same labour force participation rate, but this time it's against US government debt as a percentage of GDP. Now it's inverted here. And what it basically tells you is that as the labour force declines in size, or percentage of people involved in the labour force, the government takes on more debt to offset the growth. This is what it's all about. This is the big economic mess we're in. It's a mess created by demographics that I've talked about before. This chart is incredibly important. Now, look at the little divergence recently where government debt has been growing, but the labour force participation rate hasn't. That's the recent influx in immigration in the United States over the last 2 years, where some 6 million people or so have immigrated into the US, and that has kept the labour force participation rate higher, offsetting the retirees. But that's unlikely to continue, particularly with the new government. So what we'll see is the labour force participation rate decline and government debts keep growing. Okay, so we've got all of these massive debts. I've talked to you about the everything code. The everything code is the servicing of these debts by using liquidity. So liquidity is the debasement of currency. To service these debts, they print more money to service them. It's as simple as that. That is the game we're in. That is the everything code game that is being devalued. Now there's another maybe 3% inflation rate to add to this. So 11% is your hurdle for your future self not to be getting any poorer. And most assets just don't do it. But you can see how important it is by this chart that you should have seen before, which is the chart of the NASDAQ versus our global macro investor total liquidity. This is the total liquidity around the world. That's government liquidity, central bank liquidity, and private sector M2 and other measures. So it's the total amount of money printed by the system. And what happens is the NASDAQ is 97.5% correlated to it. That's incredible. The other extra bit that's not correlated that you're seeing now is the secular growth in technology. Because technology is a secular trend, because tomorrow is more digital than today. And obviously, Bitcoin, massively driven by total liquidity. This time it's about 87.5% correlated. Reason being, there's a faster adoption curve, exponential growth that happens in Bitcoin or all cryptocurrencies. So that's what lowers the correlation, is in fact the outperformance. But anyway, liquidity drives everything. Now, since 2008, everything has become cyclical, because in 2008, every central bank around the world reset interest rates to zero. It was like a debt jubilee. You don't have to pay your interest, so the world could kind of recover from the debt blow-up of 2008. And for about 10 years, we had zero interest rates. And what the governments did is they reset all of their debts to between 3 and 5 years. That cycle has created a perfectly cyclical business cycle. The ISM, the Institute of Supply Managers survey, what we've got here is in black is the current cycle, which is it's currently at its lows, but the forward-looking is actually just the previous cycle moved forwards and inverted, because it keeps repeating the same cycle. So that same cycle is repeatable and understandable and forecastable. Sure, the wiggles may change, the direction will be right. And it's driven by this. This is the distribution of debt in the United States. If you look at the first two boxes, well, that's 72% of the entire debt structure is 1 to 5 years, which is what I talked about before. This is what's causing the cyclicality that you see in the economy and these 4-year cycles. So because they're using the liquidity to manage the debt, the rollover years, which tends to be this yellow and the kind of weird peachy color, the summer and fall, those are when the peak debt rollover happens. So they add lots of liquidity. So if you look at that, you can see the liquidity piling into the system as they start rolling those debts over, and they need to print more money because they have to issue new debt to pay the interest on the old debt. Sometimes they use a central bank balance sheet. Other times they just create liquidity, and it's done on a globalized basis. Right now, China's the big liquidity driver. And then you get those blue years, which are the winter years, when they start withdrawing liquidity because they don't need to service the debts because there's no debts around those periods of time. So that's why we get this cycle. And this cycle creates the Bitcoin cycle. It actually corresponds with the presidential election cycle and also the Bitcoin halving cycle. They're all those summer months. The summer months tend to be pretty strong. You can see the previous examples, 2012, 16, 20, all good months, all good seasons or years. And then fall tends to be very strong. The fall in 2021 was still strong, but it had a stunted cycle because liquidity was starting to get withdrawn because they put so much in. But if you look at 2017 and 13, they were gigantic. So the fun is yet to come. When you look at it in year-on-year terms, you can see the cyclicality and how related Bitcoin is to global liquidity and how the seasons dictate that. So what we're looking forward to is the big rises in price ahead. What happens normally is around the Bitcoin halving or around the early part of crypto summer. Now, we're not talking about summer as in actual seasons. We're talking the 4 seasons, which correspond to each year. The early part of the year usually is something called the boring zone. So it starts strong and then sideways corrects after the halving for an extended period of time, and then eventually begins to break out. The breakout usually ushers in the banana zone. So we've had the boring period. It was about 8 months long. It was a nice, orderly correction. So what lies ahead? The banana zone. The fabled favorite yellow fruit of all of us. The one where our hopes and dreams are all in it. Let's talk bananas. So when we look at halvings, from the halving, you can see what happens until the end of that year. So we had 2020 at the top, was very strong. We had another strong year in 2016, and 2024, we're a bit below par right now. But don't worry about that, because you'll see it in context of everything else. We should still see extremely strong price rises. The US election, well, that's a key time for this, because after the election, we get the banana zone. There's often liquidity being injected into the system, and there's also a shared sense of optimism that drives prices higher. We are just starting that now. At time of recording, the election was 2 days ago, and already crypto prices have started their explosion into the banana zone. Bollinger Bands are a measure of volatility or lack of volatility, because Bitcoin was ultra low volatility recently. And that's really interesting, because every time you get there, when you get these kind of low volatilities, you tend to get large price rises. And we've been following that kind of price action. So you tend to get 200, 300, 400% rises over the course of 6 to 12 months. So that, I think, is another interesting signal. So suppressed volatility usually leads to hyper volatility. Also, Solana exhibiting extremely low volatility. That box in the right, it shows you that every time we've got to these levels, we've seen everything from a 25% rise to a 520% rise in 2 to 3 months. This is bananas. Now, looking forwards, the business cycle is starting to pick up. So current ISM today is very lackluster. It's almost recessionary conditions, which is why many of you think we're in a recession right now. The forward-looking indicators are exploding higher, meaning we're all going to have some more money soon, because the economy is going to be working better, our businesses will run better, our earnings will go up, and we'll feel a bit better about ourselves. That's what lies ahead and is at the essence of what matters in the banana zone. And you see the financial conditions index, which is our lead in all of this. It's comprised of oil prices, the dollar, and rates, is also suggesting that ISM leads, and it's a pretty good indicator. So that it leads ISM, and by 9 months. So we kind of know the business cycle is going to be going up at least for 9 months, and probably a lot longer. Now, here's where the magic happens. Altcoins, as a percentage of total market cap, so it's like the inverse of Bitcoin dominance, actually is driven by the business cycle. And that's because people take more risks and invest more money when they've got their earnings going up, when people think they've got a bit more money. And that is what drives altcoins. It's the same as small caps in equities. They're all driven by the same basic phenomena, which is the business cycle creates more activity, which creates more investment, which drives prices higher. So we've barely started. As I showed you before, ISM starts going up, altcoins go bananas. Now, when we measure altcoin season by using this 30-day outperformance, underperformance of Bitcoin, we're nowhere. We're still at 39%. That's mid-cycle range. We've got a long way to go. And that's when things get very excited. It tends to be the last 12 months of the 4-year season, that 4-year period. Those last 12 months are where all the returns come, and they lie ahead. Also, total liquidity is breaking out. We see these wedge patterns every time around the same time in the cycle. And then what happens is, as soon as it breaks out, Bitcoin breaks out too. We're breaking out now. China is leading it. China's injected $8 trillion of liquidity so far since, I think, October, November 2022. Europeans about $1 trillion, the UK about $1 trillion. The US has actually been about flat, but we expect them to start injecting money soon via the Treasury General account. Okay, Global M2, it's a measure of private money. It leads by 11 weeks, Bitcoin. Perfect. And Bitcoin, banana zone. We keep going. So that looks great. Now, don't get fixated exactly it's going to be 100,000, but it seems in that kind of range. Basically, a strong end to the year and should get even stronger into next year. GMI total liquidity, another fantastic correlation, same kind of outcomes. Strong Bitcoin into the end of the year. And that's what we're looking for here. Ignore the corrective price action right now on that chart because it hooks up afterwards. So we should just continue over time higher. Okay. Are we anywhere near the cycle top? I know people fret, oh my God, but Bitcoin's at all-time highs. Surely I'm going to be buying the top. Surely Raoul's shilling things at the top and he's trying to find exit liquidity and all the nonsense that people talk about online. Basically, our cycle liquidity indicator is nowhere near where it's going to go. Also, look at the acceleration that happens before it peaks out. We haven't done anything yet. This has been super mild. So expect the acceleration ahead. If we look at prior cycles, we're kind of nowhere in the current cycle. We're nowhere. We've still got the exciting part where prices go vertical lying ahead. It's the light blue line here that's a little bit hidden. But really what we're doing is we're more closely following, let's say, the 2015-18 cycle, which I think is how it plays out this time, as opposed to the stunted cycle of 2020. But that remains to be seen. Why this matters is crypto in the end is the best performing asset class in all recorded history. It dwarfs anything else. So Bitcoin does about 142% annualized returns. This is actually a table from Exponential Age Asset Management, my asset management firm that invests in crypto hedge funds. So we invest on behalf of high net worth individuals, pension plans, institutions, etc. And Bitcoin, Ethereum, Solana, the returns are an order of magnitude different to the next best performing asset, technology stocks, the Nasdaq. After that, you get to the S&P 500 of 13%, which barely beats that 11% hurdle rate, and nothing else beats it. The long-term returns of small caps, large caps, REITs, treasuries, nothing. They all are destroying your future wealth. So really, this is the powerful thing, the crypto supermassive black hole that outperforms everything. The Nasdaq actually is down 97.5% versus Bitcoin since 2012. 99.97% versus Bitcoin. So that's how powerful an asset crypto is. This supermassive black hole sucks in everything around it. And it happens because this is all about a technology that is growing. So this is a chart of the number of users of crypto by using wallet addresses versus internet users from 1992, when the internet was at 5 million and we started wallets from 5 million. Now, internet users is IP addresses. We've all got many IP addresses. Crypto wallets, well, they're wallets. They're not necessarily daily active users, and we've all got several wallets. So it's comparing a similar like for like. But currently, crypto has been growing at twice the speed of the internet. Now, on this chart, we assume the internet actually slowed down in year 8, 9, and 10. So we've assumed the same rate of growth as the internet, not a doubling of growth. If it was a doubling of growth, it's probably growing at 80% a year, which I think is more likely. But we slowed it down, and we get to 1.1 billion wallets or users, in inverted commas, by the end of 2025. 1.1 billion. Okay, that's huge. But it's not as huge as if we extrapolate out to 2030, that fabled date where I think we've got 6 years to unfuck our future and invest before things change. At that point, crypto starts to become quite saturated in terms of its growth, because suddenly you're at 4 billion users and we can only double in growth to 8 billion users. Yes, on-chain activity will grow and that will drive more metrics and still drive prices, but generally the bulk of the returns happens between now and 2030, which is why I'm so anxious for everybody to make sure that they unfuck their futures doing this. It's a huge thing. And that's what's driving this beautiful log trend Bitcoin. Over time, number go up because people use blockchain technology because the world is more digital than today. And we've barely started the rise. We usually get to 2 standard deviations overboard. Will we get that far or not? I don't know. If it's 2 standard deviations, we're talking $500,000. That sounds a bit too racy to me. Maybe it gets to 1 standard deviation because each cycle is a little more muted than the past. Either way, expect prices to rise from 150 to 450,000 over the course of this cycle, depending how it pans out. Again, no guarantees here, but just to give you an order of magnitude, and filming this today, we're at 75,000. Okay, got it. And then finally, the banana zone, just so you can visualize what this means to you and your returns and how the banana zone how you unfuck yourself with the banana, as those NFTs say that Real Vision's produced, is this. Things go vertical. This is the time not to lose your minds. This is the time not to FOMO in all the stupid shit your friends are making money in. This is the time to just do nothing. You should have already made your allocation. Maybe a bit of Bitcoin, a bit of Solana, a bit of ETH. Maybe you've gone out a bit the risk curve like I have, and SUI, which is one of the newer chains that's gaining massive adoption. Or maybe you're playing around a bit in memes. But remember to not fuck this up. My don't fuck this up thesis is don't use leverage. Don't FOMO into stuff. Have 90% of your assets in the core top 3 coins. And then with the 10%, you can speculate more, whether you want to have a meme or whether you want to look at some smaller projects. So that's how I like to think about it. That way, you generally won't fuck it up. It's by over trading, trying to trade breakouts, using leverage. Don't use leverage, please. Because what happens is you get it wrong and you lose your coins. We have one job here. One job in a secular megatrend like this is not to lose control of your coins. That means don't fuck around too much in DeFi. Don't give your coins to anybody. Just do nothing. Use that 10% if you want to feed your inner DJ, or you want to learn new things and how things work, but don't do it with your full stack.
The future looks incredibly promising for the cryptocurrency and digital asset space as we move into 2025 and beyond. We invite you to share your views on Raoul Pal's insights, as well as your thoughts on the upcoming developments for Bitcoin and other cryptocurrencies in the comments below. Be sure to give this video a thumbs up, subscribe to the channel, and enable post notifications to stay updated with more content like this.